Good afternoon and welcome to the Wealth of Advice market update on Friday the 26th of June 2020. It's been a very volatile month if you consider what happened the previous 4 weeks when markets seemed to go up pretty much every day through the month of May. We've gotten into June, the excitement if you like in the economy that shops and restaurants and businesses are all going to start to reopen. You would have thought would have been a surge up in market values. The markets have risen through the month, but we had that major setback around about the 11th of June when markets fell. But then from that period, markets have recovered, dropped down, and then up again. This week hasn't really been that positive overall for markets. There's a big fear that coronavirus is still sort of looming large in various parts of the world, and that could cause a second spike, which could cause markets to get really worried and fall again in the future. So in UK news this week, Boris gave the country the announcement they were all waiting for. Pubs can reopen on the 4th of July. Better news for markets, the progress on the EU negotiations seems to be coming along. That's going to be very important for markets as we pass forward. Intu, which owns the Metro Centre in Gateshead, as well as many shopping centres across the northeast England, they own I think 6 out of the top 10 shopping centres in America as well. They've filed for bankruptcy, and that's showing you that the commercial property sector has taken a real battering. This is something that's been coming for the last however many years. The advancement of Amazon has seen people shop less on the high street. We got rid of around about £7 million of our clients' money that was invested in the Janus Henderson Property Fund last year. The Janus Henderson Property Fund didn't invest in Intu, but I think it held Dalton Park was one of the main shopping areas it owned. So we felt the writing was on the wall for commercial property funds a long while ago. So hopefully it's another confirmation that we did the right thing to get out of that fund at that time. The first slide I wanted to show about Brexit and the effect it's having on markets overall. We go back to the 23rd of June 2016, seems ages and ages ago. If you remember that this vote happened, the campaign to leave the EU won the vote, and we agreed that night that we were going to leave the EU. What's then followed has been what seemed like Groundhog Day in discussions and negotiations. Tory prime ministers have come and gone on the back of what happened with that. But there was an interesting article I was reading on Tuesday which said that a lot of UK companies' share price was around about 20% lower than what it perhaps would have been when you look at rivals in Europe and overseas from what the companies were actually worth. So we thought, well, what will this look like if you put it on a graph from the 23rd of June 2016 up to this week, because that's the 4th anniversary of the Brexit vote going through. And as you can see, the FTSE 100, the top 100 companies in the UK who might get 80% of their earnings from overseas anyway, the FTSE 100 has massively underperformed those other stock markets. The S&P in America has surged ahead, and we've said on previous presentations, a lot of that's through the fact that the American stock market is dominated by various technology companies. We don't have those in the UK. But the MSCI World Index, which is an index of world stock markets and companies around the world combined, again, you can see from that graph there how far ahead the MSCI World Index is compared to the FTSE 100. And the article we were reading on Tuesday was, if the UK can get a good deal, can negotiate well with Europe, they would expect a rather quick bounce in UK stocks. So obviously these presentations over the last couple of months have been dominated by talks about the coronavirus and the negative impact that has had on clients' investments and funds. The Brexit story, which was on the news every day for the last couple of years, which stopped being the main news story come the end of January and going into February, and the coronavirus really struck. This is just to get our attention focused back to that. So those clients with UK held investments, the underperformance of the UK markets has already happened. Would a bad Brexit deal further bring the markets down? Yes, there might be some short-term shock, but as you can see from that, the last 4 years have been quite poor for UK investments as a result. So hopefully Boris and his team of negotiators can get us a favourable deal, and the UK markets can surge up as a result after that. So in world news this week, again in America, we've mentioned this previously, lots of states have shown record increases in the coronavirus. That's worrying. It clearly shows that states over there reopened too soon. people are going to become ill, hospitals may become overloaded. So one thing that we've been looking at, and Dr. Fauci in America said you should do this, don't necessarily look at the infection rates, because the number of people who are being tested is increased massively, and that applies in the UK as well. What you should be looking at is the actual hospitalisation rates and the death rates. In the UK, thankfully, the hospitalisation rates and the death rates have come down. In America, they're going up. There was a worrying story at the beginning of the week that the German R rate had gone above 4%. Then by Wednesday or Thursday, we read another story saying it had spiked, but it's come down to 0.72%. In this fast-moving time of news stories, the data that's been analysed and looked at, you hear one story one day, that's worrying. The next story, the day after, looks a little bit more reassuring. Markets could fall on the back of that, and that's what we look at on a daily basis. I think I've said I watch Bloomberg on a morning and on an evening now, watching how the markets open, how the markets close on a night. From your point of view as a client, I wouldn't necessarily be saying you should be checking your valuations every day. You remember back to the investor psychology slides we put in a previous presentation, where the more frequently you look at a valuation, the more often you might see negative news. So still look at it maybe once a week, once a month. We're the people who's looking at it on a daily basis, and we're just trying to share these stories here now to show you what could affect the market. Outside of the US, because we do speak about the US quite a bit, Germany this week, we mentioned the R rate, but also Lufthansa, a huge airline in Germany, was almost about to go bust, and there was talk, certainly I think it was Wednesday morning, that was a likely event to happen. They've got a huge investor in Lufthansa who wasn't playing ball with what the government wanted to do to change how the company was run. Lufthansa going bust would have a massive implication for Germany. Yes, we have EasyJet, Wizz Air, Eurowings is another German small airline, but ultimately Lufthansa is the main German carrier. Without Lufthansa, so much trade and industry in that country would fall and suffer, so you would have to see some government intervention. Any news story like that is going to be a worry. Across in China, we mentioned last week that there was a big cluster of infections again. As I said, a military regime which runs the country immediately locked down certain parts of that city, and again a week later we hear that it's under control. Hopefully this is what the next few months will be, an outbreak, a look to control, a look to bring the numbers down, and then the economy continue tracking along. So overall, any real negative news stories this week that we should be really alarmed about? I haven't seen any that really alarmed me. A few worrying stories, but now we look forward to what July may bring. We're moving now to the section of the presentation where we talk about the Royal London portfolios, and this week I just want to look at how they've performed actual year to date, so from the beginning of January to now. Certain funds in the US stock markets, I think some Asian stock markets have performed from year to date till now, and they're in a profitable position, and a lot of those stock markets have been dominated, as we've said in previous bits of the presentation, by large technology companies. So they've surged ahead. They're the companies who've done very well through the crisis. The Royal London portfolios from January till now are all negative. Obviously what you can see in the middle of the graph you're looking at now is a very negative impact on funds. We've then showed you as the time has gone on how the markets have recovered and how they've picked back up, and the Royal London quite cautious portfolios, the GRIP portfolio 3 during 2020 is negative by -4%. The Government portfolio 5, which has a much higher stocks and shares content, is still down by -7.3% from the beginning of the year. The next graph what we want to go through is then when you actually look at the 3-year performance. I spoke with a client the other day who rang up in his opening words, well, what's the damage? Where am I at with this? And he was expecting to hear, he clearly doesn't watch these presentations, but he was expecting to hear that his portfolio was down 15-20%, and then we're asking for the performance over the long run. He was extremely surprised to say that over a 3-year period there was positive growth in there. Now clearly 5% growth over 3 years is not what you want to be achieving if you are a client who's in drawdown and who's taking a regular monthly income out of it, or has aspirations on what to do with the fund. So again, the Royal London funds that we've highlighted there are 3 quite cautious portfolios in the overall scheme of things, and for them to still be showing positive growth over 3 years, albeit 5% on the GRIP portfolio 3 and 4.5% on the other 2 portfolios there, I think is encouraging that we are going to come back. And when you consider it was only 3 months ago that those were negative over 3-year periods, we should certainly be happy with that. You then roll that forward to 5-year performance. I was again in with the client earlier today who was looking at some product illustrations from a pension provider, and the FCA's product illustration suggested illustration growth rates is 1.4% growth, 1.6% growth, or I think the high one was 4.6%. How can that be achieved over the long run? Well, 4% growth every year for 5 years. There will be a higher uptick when you add in the cumulative growth, but 5 times 4 is 20%. So if you look at a 5-year growth performance there for the GRIP portfolio 3, which is predominantly government bonds and corporate bonds, 25% growth, and even the government portfolio 5, which has got probably 60% in the stock market, maybe a little bit more, 65% maybe, that's 23% growth over 5 years. So even taking into account that the biggest collapse we've seen in modern times over 5 years, the person who's doing a drawdown plan through Royal London is still in the more positive territory that you would see on an FCA projection of what the growth may be. Obviously, the longer term with all investments is what you need to be considering. Now, moving on to the Risk Score 2 and Risk Score 3 portfolios. This graph shows the performance over the last month. Again, a positive graph to show. And for the first time, I did promise that this would happen at some point in the year, for the first time, the Risk Score 3 portfolio, the one with the higher exposure to the stock market, around about 55 to 60% usually will be in the Risk Score 3 in the stock market, whereas the Risk Score 2 should be no more than 40%. That has now taken over the blue line, albeit they come back down in the last couple of days and they're kind of kissing again. But that period a couple of days ago was the first time you'd seen the funds go up. The Risk Score 3 ended the week 96,249, and the Risk Score 2 was 96,182. So from that notional £100,000 that was invested at the height of everything, middle of February, to now, you're only 3% down, 3.5% down on average. The performance of the Risk Score 2 and the Risk Score 3 portfolios from the middle of January to now, we're not back in positive territory from that notional £100,000 that was invested. But as I say, as per the first graph, this is just an extenuation showing year to date. You might want to consider it. When we look at the next graph, probably is more relevant over 3 years. Again, imagine that client who's wondering how has these portfolios performed over a longer term. So I should say anyone who's comparing these to the Royal London portfolios, the Risk Score 2 and the Risk Score 3 portfolio are a little bit riskier. So if you were recommended Royal London, that would have been part of the consideration there. But the Risk Score 3 portfolio over 3 years is up 10.58%. Clearly, we would always want that to be higher. Anyone who's withdrawing a high level of income from such a plan would be worried if that was to be the annual growth rate over the longer run. But now when we look at the Risk Score 5, the Risk Score 2 and the Risk Score 3 over 5 years, you can see that you are being rewarded over the longer term, and risk is being rewarded as well. The Risk Score 3 portfolio clearly outperforming the Risk Score 2 portfolio. So when we talk about attitude to investment risk from a client's point of view, clearly nobody wants to go through what happened in March and April, but it's showing you there that if you are prepared to tolerate the ups and downs, markets will recover, funds will recover, patience is obviously needed, but if you've got a long-term investment horizon, which virtually all of our clients have, we see a lot of clients who want to do income drawdown. It's a retirement plan, as well as people who want to invest money for the future. But most people look at the longer term. You can clearly see there over 5 years, the Risk Score 3, up to 60% in the stock market, has outperformed. That massive reduction that we saw at the end of March is now almost overcome. There's still a long way for markets to go. There's still going to be some ups and downs. There's still going to be some substantial sort of news stories to come through in the next couple of months which would affect this. But overall, we're now more happy and relieved as to where the funds are going. So thank you again for listening. Hopefully you continue to find these presentations interesting. We are also now starting to pick up the phone more and speak with more clients to invite people in for their regular annual reviews. I've seen about half a dozen people this week. So we're now looking through the backlog of people who should have been seen during the months of April and May, and obviously June now. So thanks again for watching, and if you need anything from us, give us a call.